Welcome back, everyone. Today we're tackling something that's been on the minds of family farm owners across the UK: the changes to agricultural property relief. Now, the headline you might have seen talks about a £1 million cap, but there's actually more to the story, right?
Exactly. That headline caught a lot of attention. But here's the thing. The government announced on 23rd December that the combined allowance for 100% APR and business property relief has actually been increased to £2.5 million per individual. So it's a bigger threshold than people initially thought.
2.5 million. That's a significant jump. So when does this come into effect?
From the 6th of April 2026. And this applies to both agricultural property relief and business property relief combined under one cap. So if you've got qualifying agricultural property and business assets, they share that £2.5 million allowance for 100% relief.
Okay, so let's break this down for everyone listening. What happens if a farm's value exceeds that threshold?
Good question. For any qualifying property over 2.5 million, the relief rate drops to 50%. That means you're effectively paying inheritance tax at 20% on the excess, instead of the usual 40%.
So it's not zero relief anymore, but it's still reduced. Now, um, what kind of property actually qualifies for APR in the first place?
Agricultural property includes agricultural land or pasture, woodlands used with agricultural land, grazing land, and buildings like cottages, farm buildings, and farmhouses, as long as they're of a character appropriate to the property.
Right. And what about ownership conditions? How long do you need to own the property to qualify?
Generally, you need to have owned it for at least 2 years if you're farming it yourself. That's in hand. If the land is let out, the ownership period extends to 7 years. I actually worked with a farming family last year who didn't realize they'd hit the 7-year mark on a let property, and it made all the difference when we reviewed their estate.
Mm-hmm. Timing matters. That point about ownership periods sets up our next piece: how couples can actually maximize this allowance. But first, a quick word from our sponsor.
At Carr Jenkins Hood, we help businesses big and small work through complex financial challenges. With over 40 years of experience, our team of chartered accountants and tax advisors provides sound, qualified advice suited to your needs. From bookkeeping to specialist tax relief, we pride ourselves on developing long-standing relationships and delivering a competent, high-quality personal service. Find out more at www.carjenkinshood.co.uk.
Picking up on ownership periods and how timing plays into planning, how do married couples or civil partners handle this new allowance?
Here's the really important part. Any unused portion of that 2.5 million allowance can be transferred to a surviving spouse or civil partner. And this applies even if the first death occurred before 6th April 2026. So essentially, a couple can pass on up to 5 million in qualifying agricultural or business assets tax-free, on top of existing nil rate bans.
5 million combined. That's substantial. Let's walk through a quick example. Say a farm owned by two people is worth £3 million. How does that work?
Sure. So each person has their standard allowances, the nil rate band of 32,500 and potentially the residence nil rate band of 5,000 if they're passing it to direct descendants. On top of that, they each get the 2.5 million combined allowance for APR and BPR. Between the two of them, that's 5 million in combined relief, which easily covers a £3 million farm.
That makes it much clearer. So to everyone listening, if you're planning your estate, these spousal transfers are critical to understand. Now, what about the estates that will be affected by these changes? I've heard the numbers are actually quite small.
That's right. Based on the latest data, up to 185 estates claiming agricultural property relief are expected to pay more inheritance tax in 2026-2027. That means around 85% of all estates claiming APR won't be affected at all.
So the majority of family farms won't see a change?
Exactly. The median value of assets qualifying for APR back in 2021-2022 was £48,600, well below the new threshold. The reforms are really targeting the very high-value estates. In fact, in that same period, 40% of the total relief went to just 7% of claims.
That's quite the concentration. So the policy objective here is fairness, making sure the relief goes where it's really needed, rather than to a small number of very large estates.
Right. The government's stated aim is to raise revenue for public services while still supporting farms and businesses. They want to make the reliefs fairer by targeting them more effectively. You could say they're trying to level the playing field a bit, though I'm sure some would argue about what level looks like when you're talking millions.
Ha! Fair point. Now, for those farms that will be affected, what practical steps should they be taking now?
First, get a current valuation of your estate. Second, understand how the combined APR and BPR allowances apply to your specific assets. Third, consider lifetime gifting strategies. Transfers made more than 7 years before death fall outside inheritance tax entirely. And definitely speak with a qualified advisor who can help structure your estate to minimize liabilities.
Those 7-year gifts are powerful. And I should mention, there's even a taper relief if you don't quite make 7 years, right?
Right. If the donor dies between 3 and 7 years after making the gift, the tax due is reduced. From 3 to 4 years, it's 32%, 4 to 5 years, 24%, 5 to 6 years, 16%, and 6 to 7 years, 8%. So the earlier you plan, the better.
One more thing I want to touch on: payment options. If a farm does owe inheritance tax, how does that work?
Great point. The option to pay inheritance tax by equal annual installments over 10 years, interest-free, has been extended to all property eligible for APR or BPR. So you're not forced to sell the farm immediately to cover the tax bill.
That's definitely helpful for cash flow. Have you thought about how these changes might affect your own family's farming legacy?
It's a question worth asking yourself. Before we wrap up, any final thoughts for family farm owners listening?
I see, go on.
I'd say this: don't panic, but do plan. The changes are significant for some estates, but the majority won't be affected. Still, it's wise to review your situation now, understand your numbers, and look at your options. The rules take effect in 2026, so there's time to act.
Solid advice. Thanks so much for walking us through this today. And to everyone listening, we hope this helps you manage the new APR changes with confidence. Until next time.